Hi everyone, and Happy New Year. Thanks for joining our Phillip's Research Morning Call today. Today we have quite a few numbers of stocks counted that we'll be running through, and Zain will be touching on some technicals. And as for macro, we'll be covering on the Magnificent Seven, FANG, Banking, and REITs Monthly, while ending it off with a quick recap on our Singapore budget and our usual Singapore Weekly. So without further ado, let me hand over the time to you, John and the US team to share on the Magnificent Seven. Thank you.
Thanks, Sean, and good morning, everyone. Yeah, so I'll just be sharing. We actually changed from the FANG monthly to the Magnificent Seven monthly, so we dropped Netflix and we added Tesla and Nvidia in our monthly report. Next slide. So overall for the performance, there's a small typo here. Sorry, it should be January 24. Essentially, the MAG7 was up 2%, beating both the S&P and the S&P 500 and the Nasdaq 100 slightly. Nvidia was the biggest gainer, up 24%, while Tesla was the biggest laggard, down almost 25%. Basically, most of the MAG7 companies actually announced accelerating revenue and earnings growth during their fourth quarter earnings calls, which we'll get into over the next slide. Yeah, so if you look at this chart, this table, sorry, essentially for revenue growth, most of the Magnificent Seven companies beat their guidance. Tesla and Alphabet didn't really give any guidance, but they were still in line with consensus estimates. But the big kicker here was PATMI growth, which accelerated compared to the third quarter, so it was up 55% year on year. I believe in the third quarter it was up about 45%, so it was quite a significant re-acceleration in PATMI growth. A big reason was mainly due to higher operating leverage. A lot of the top line was growing, while a lot of the Magnificent Seven companies cut headcount, used a lot of their expenses. And so, naturally, you saw a lot of the additional revenue just flow straight through to the bottom line. In terms of guidance, most of the MAG7 companies issued positive guidance, except for Nvidia, which has yet to announce their earnings. And also aside from Apple and Tesla. So Apple and Tesla gave kind of muted guidance, mainly due to kind of a muted demand for hardware, especially for iPhones. And for Tesla, it was a little bit more about slowing growth because they're focusing a little bit more on developing new products rather than scaling and pushing out their existing products. Next slide, please. So we'll dive into just a quick recap. I won't go into any of the earnings because we'll talk a little bit more about that next few slides. But for Nvidia, the big news is that they're going to be beginning production of their China-focused H20 chips, which essentially are US compliant chips, GPUs that are essentially supposed to take the place of their new H100 chips. So the backstory is that their H100 chips essentially are banned in China, are banned from exporting into China. And so because China makes up about 20% of Nvidia's revenue, is quite substantial, they kind of have to figure out a way to I guess, mitigate these export bans. And so they developed these new H20 chips, which are not as powerful, and do meet the requirements of the export restrictions, so they can easily export it to fulfill some of their major customers' orders. Because the worry is that if they don't fill it, then the Chinese will just develop their own AI GPU chips, and the business will be lost forever. So quite a big development here. The other big news is that the CEO Jensen Huang actually met with execs from TSMC, which is the chip manufacturer, to try and mitigate a lot of the supply constraint issues that not just Nvidia is facing, but also AMD and other chip manufacturers. Because the biggest issue for growth here, or for AI growth, is actually production issues. They're not able to meet the current demand for in terms of supplying the chips to companies like Nvidia and AMD. So that is kind of stifling revenue growth on for both companies. Yeah. So moving on to I won't run through Alphabet, but I'll go through Tesla's deliveries. So they actually beat fourth quarter deliveries, 485,000 versus 483,000 estimated. So quite a marginal beat. But in terms of China EV sales, which was kind of a surprise, this number actually grew about almost 70% to 94,000, which was the second highest monthly record. And this was sales for December only. So we're starting to see some sort of pickup in terms of demand for EVs in China. Yeah, next slide, please. So I'll run through Amazon's. Other than Amazon's earnings, they're actually continuing to lay off more people, so they're starting to, or they're remaining more prudent on their expenses. They're leaning out continuously, which should be a positive for margins. At the same time, they're going to be investing slightly over 15 billion over the next few years to bolster cloud computing in Japan, which is basically 50% more than what they've made in total investments in Japan over the last decade. So they're really pumping into a lot of IT infrastructure, especially with AI demand so strong, and they expect AI demand to come from a lot of these North Asian countries like Japan and Korea. Yeah, next slide, please. Microsoft, earnings were pretty good. So we won't really go through that. Next slide, please. In terms of our overall rating on the Magnificent 7 stocks, we remain overweight. We still think that there's a lot of positive near-term guidance from these companies. AI demand remains extremely robust. So it's very difficult to kind of go against this because it's the order backlog for a lot of these companies are growing just because demand is so high. At the same time, for digital advertising companies like Meta and Alphabet, they're seeing some sort of stability in pricing of ad pricing. So what has actually been happening over the last 2 years is that ad impressions have actually grown, but the real downside is that ad pricing has actually declined, on average about 5 to 6% year on year. This is mainly because a lot of the growth is coming from lower monetizing regions like South America or the Asia Pacific region. So right now what we're seeing is some sort of stability in pricing, which is good because we expect moving forward it will no longer be a drag, and we expect the digital advertising industry to recover a little bit faster. In terms of tech hardware, like your Macs, your PCs, your iPhones, you still see a lot of softness there. At the same time, we see EV margins being compressed because of intensifying competition, especially in China. So a lot of the price cuts are still ongoing, which negatively and instantly impacts our margins. And we expect this won't really abate anytime soon, and so we expect margins to remain fairly suppressed. So that's all for the Magnificent 7. We remain overweight. Other than that, we still remain overweight just because there's a lot of tailwinds that are greater than the headwinds. So moving on to my next counter, which will be Meta Platforms. They announced their fourth quarter earnings last week. And they actually had really good earnings, which beat all around both on the top line as well as bottom line. In terms of their fourth quarter results, or rather their full year 2023 results, revenue was at 102% of our forecast, and PATMI was at 109% of our forecast. The big thing here is Meta continues to ride the digital advertising recovery wave. At the same time, over the last year or so, they've leaned out very significantly, and so they've reduced quite a lot of expenses. They've reduced headcount by about 15 to 20%. And so any incremental revenue that you see here, it's basically gone straight to the bottom line. You see revenue year on year has increased 8 billion, but PATMI has increased 10 billion. So what we're seeing is significant operating leverage, significant efficiency increases, and that we expect this to continue moving forward because based on the company's commentary, they don't expect to be increasing spending that significantly. They're going to be remaining quite prudent, which is a good sign. At the same time, Reels, which historically has been a net negative, is actually finally contributing net revenue, which is a positive because there's more people and more eyeballs shift from static feed towards short form video platforms like Reels. It will be more of a tailwind compared to the past where it was just a drag because you're essentially kind of cannibalizing your own digital advertising business. The only real knock was that Meta actually raised the top end of their CapEx guidance by a little bit, mainly due to plans to increase AI investments in their AI infrastructure to support increasing more intensive AI product development, which is kind of expected. It's just we didn't expect such a significant increase so soon. In terms of outlook, outlook is still expected to be very strong in terms of revenue growth. 25% year-on-year revenue growth, roughly in line with the fourth quarter's revenue growth. For expenses are expected to grow a little bit for 2024. So overall, we are still quite positive on Meta. We actually downgraded from a buy to an accumulate, mainly because of share price performance. I believe the stock rose about 20% after it announced its earnings, so quite a significant movement. But we still are quite positive because we expect them to ride the wave of digital advertising as the industry recovers, especially because it's only basically them and Google that are the two main players there. We raised our 2024 revenue and PATMI estimates by 3% and 9% because we expect stronger ad revenue for this year. We also raised our target price from $375 to $520. Also because we roll over an additional year of valuation, so that kind of helped to bump up the target price a little bit. So that's all for Meta. I'll move on to my next counter, which is Spotify. So Spotify also announced their earnings, I believe, 2 weeks ago. For Spotify, it's a little bit different. They're more of a growth story. So right now, or rather throughout most of 2023, and what we really saw was a significant growth in monthly active users as well as premium subscribers. So for monthly active users for the whole year, roughly about 20 to mid-20% year-on-year growth, which is quite significant. For premium subs, it's slightly lower, about 15 to 18%, but still very good. So what we expect for Spotify is that we think they've reached a certain level of scale with the number of users that they have on their platform already. And what we expect is some sort of margin boost because over the call, the commentary was that they're going to be focusing a little bit more on monetizing its existing users, whereas for most of last year, they just kind of focused on growing the user base. So when it starts to monetize, that means raising prices, trying to incorporate a little bit more advertising revenue into its business, especially into its podcast business and so on. And so what we should expect to see is margins continue to expand sequentially throughout 2024, which is a good sign, because Spotify as a company was barely or was a slight negative or around break even for 2023, and so for 2024 we expect some profit, about 600 million euro profit compared to 2023, and then a significant increase in 2025 as well, just because of the operating leverage that we expect them to have. So in terms of the outlook, margin outlook expected to increase sequentially, which is a good sign. Revenue growth expected to re-accelerate or continue accelerating to about 18% year-on-year, compared to 16% in the fourth quarter. In terms of rating, we maintain an accumulate rating, but we raised our target price from $190 to $270. A big reason is because we raised our 2024 PATMI estimates by about 4 times. So our previous estimates were about 150 euros, and we raised it to close to 600 million euros. So it's quite significant because the base is so low, that hence the 4 times. We still expect Spotify, long term, to benefit for all of the shifts in consumer trends, consumer preferences, and using Spotify's platform more instead of listening to radio, for example. And with this high base and the added value that they deliver to its customers, we think that they'll be able to raise their prices without really that much customer churn, and coupled with the fact that advertising revenue should start to benefit a little bit more, especially as they increase in scale with the number of users that they have. So that's all for me. I'll hand it over to Helena to cover Apple and Amazon.
Thank you, John. Okay, so moving on to Apple. Apple has released its first quarter 2024 earnings. So the result is within our expectation, with revenue and PATMI as 30 and 33% of our FY24 forecast. So their revenue grew 2% year-on-year. Service growth of 11% year-on-year still remains the standout, with their install base climbing to 2.2 billion. So Apple has delivered very strong gross margin in this quarter, coming at 45.9%, which is on the top range of their guidance of 45 to 46%. The expansion is driven by a higher mix of the pricier Pro version of the iPhone and the service growth. So we do expect a sustained growth in gross margin as Apple's revenue mix is now shifting more towards services, and services growth has been really robust, and its gross margin is almost twice of that of products. Moving on to the negative, China's outlook still remain very weak. Sales in China contracted 13% year-on-year this quarter as competition with local brands like Huawei intensifies. As local brands, they're also trying to edge into the higher end market that Apple has traditionally dominated. So this would definitely remain a drag on product growth, especially when iPhone accounts for 58% of Apple's total revenue. So on top of that, weak demand for products still remain a drag. Product revenue remained flat in the first quarter of 2024. iPad and wearables saw revenue decline of 26% and 11% year-on-year due to different product launch times and muted demand. iPhone revenue saw a 5.9 year-on-year increase, but with China market being weak, the outlook is also quite weak. Apple expect the second quarter of 2024, the revenue to remain flat, along with flat iPhone growth. Services is expected to continue a strong growth trend similar to the first quarter, which is 11% year-on-year. iPad and wearables is still expected to be a drag on the overall revenue growth due to continued weakness in demand. In terms of margins, Apple is guiding a gross margin of 46 to 47%. Their guidance for the second quarter of operating expenditure is 14.3 to 14.5 billion, which implies roughly flat to low single-digit growth as the company still remain quite prudent about expenses. So overall, we downgrade to a neutral rating from accumulate due to recent share price gains. So our target price actually remained unchanged at $194. There's no change in our forecast. That is all I have for Apple. Let's move on to Amazon. So Amazon has ended their 2023 with a pretty strong quarter. Their revenue increased 14% year-on-year. This is in line with our expectation. Their PMI grew almost 3 times year-on-year. Their operation income grew 5 times year-on-year. So this outperformance was due to the cost efficiencies and the higher operating leverage. Their retail operating income was driven largely by regionalization and efficiency. So their regionalization and expansion of their last mile delivery facilities increased same-day delivery by 65% year-on-year. Their improved inventory placement drove for faster delivery and lower transportation distances. So they managed to lower down their cost to serve by $0.45 per unit. We foresee that this revenue growth will continue in the long term because lower cost, it can lower the ASP, so it actually improves affordability. So this, together with faster delivery speed, should be able to lead to greater purchase consideration and frequency. Advertising growth still remains robust. Their revenue grew 27% year-on-year in the fourth quarter. This is primarily driven by the sponsored product with higher ads relevancy. So Amazon, they actually benefit from being able to collect its own first-party data and then efficiently convert this data to make sure that their ads are more efficient and relevant to their customers. So kind of driving up the ROI for the advertisers. We believe advertising still remains Amazon's great growth opportunity as it has the ability to scale alongside with its retail business. And right now, advertising only contributes to 8% of the company's total revenue. Last point, AWS is seeing stabilization in growth. It was up 13.2% in the fourth quarter compared to 12.3% and 12.2% in the previous 2 quarters. So AWS revenue growth actually dipped in the previous quarters due to customers moderating their spendings. So the recent acceleration in growth rate kind of suggests that this effect has bottomed out. Accelerated new deals and backlog conversion is expected to drive growth. Management has indicated that the acceleration in growth will continue in FY24, driven by the accelerating demand in Gen AI. AWS order backlog grew 40% year-on-year in the previous quarter. So Amazon has guided the first quarter of 2024 revenue to be at a growth of 8 to 13%. Their operating income growth would be 67 to 150% year-on-year. They are anticipated to increase their capex, primarily driven by the increased infrastructure in order to support the growth of their AWS business. This includes additional investment in their generative AI and large language models. Overall, we maintained a buy rating. We have increased our PATMI forecast by 48% due to the increased operating leverage. So our target price has increased to $215 from the previous $190. That's all from me. I'll pass my time to my colleague Ambrish to talk about Boost.
Thank you, Helena, and good morning, everyone. So moving on to PayPal's fourth quarter results. Overall, the results met our expectations with full year revenue and adjusted PATMI coming in at 101% and 102% of our forecasts. So in terms of positives, total revenue, it grew by about 9% year over year. And we believe this was mainly because of two reasons. First of all, the total payments volume on PayPal's platforms, it surged by about 15% year over year to $410 billion. And management highlighted that this was mainly because the consumer spending, it remained resilient on its platforms like Braintree and Venmo. And secondly, the number of active, secondly, it's focusing on increasing the user engagement. And so like, for instance, the number of transactions per active user, it grew by about 14% year over year. And this was mainly because of continuous product enhancements. And so like recently it has integrated a feature like passkey into its platform, wherein it could speed the checkout process. And lastly, PayPal, it's also focusing on driving operating leverage through cost-cutting measures. So, for instance, its operating expense, they fell by about nearly 20% in the fourth quarter. And this was mainly because of the cost-cutting initiatives like layoffs and real estate consolidation. And management, it also highlighted that for 2024, the company, it plans to reduce its workforce further by about 9%. Moving on to the negatives, the PayPal's active number of users, they dropped by about 2% year on year to 426 million. And this was mainly because the churn out, it happened from the number of users who are comparatively less active on its platforms. And secondly, the gross margins, it has been declining over the last couple of four quarters or so. And in the fourth quarter, it contracted to 46%. And this was mainly because the strength in its payment volumes, it is coming from its Braintree segment, which is comparatively a lower margin business for PayPal. And as a result, in its cost of goods sold, it grew by about 17% in the fourth quarter. So moving on to the outlook for full year 2024, company, it did not specify its revenue or total payment volume guidance, but it mentioned that it expects the consumer spending to be comparatively resilient and macro trends to remain similar as compared to the previous year. But it also mentioned that it expects the gross margin to further contract in FY24, mainly because of the strength in its Braintree unit. And in terms of its bottom line, it expects its adjusted earnings per share to be about $5.10, which is in line with the previous year, FY23. And this was mainly because it plans to reinvest back into its business. And in terms of its valuations, we have lowered our target price to $83 from the previous $101. And this was largely because we reduced our adjusted PATMI by about 13% in order to reflect the gross margin consolidation. And also, we maintained our WACC and terminal growth rate constant at 7% and 4%. But overall, we maintain our buy recommendation mainly because we believe that the gross margins, it should stabilize in next year. And also, it should benefit from the shift to digital commerce, and it should benefit from its two-sided network effects, like it has a global presence across 200 countries, and it has about 426 million of users, and it should benefit from its subscriber base, which includes consumers as well as merchants. So, and also going forward, it plans to use the consumer data through AI. It can offer like marketing techniques to reward points to its users, and which can boost the payment volumes on its platforms. So that's all for me. I would now like to pass on to Glenn for DBS.
Thanks, Ambrish. Yeah. So for DBS, they released their results about a week and a half ago on 7 Feb. So their fourth quarter adjusted PATMI of 2.39 billion was slightly above our estimates, mainly due to higher net interest income, fee income, and other non-interest income, which was offset by higher allowances. And their FY23 adjusted PATMI is at 102% of our FY23 forecast. So I think the main highlight for the DBS results would be their dividends. They raised their fourth quarter 23 dividends per share by 29% year-on-year to 54 cents, with an additional 1-for-10 bonus share issue. And this resulted in a dividend payout ratio, which was higher at 48.5% in FY23 compared to 47.7% in FY22. Now, moving on straight to the positives. First positive is that their net interest margins and net interest income has continued to increase year-on-year. The net interest income rose 5% year-on-year, and this was mainly due to an 8 basis points increase in the net interest margins to 2.13%. However, we did see this 6 basis points dip in quarter-on-quarter from 2.19% in the previous quarter. And the loan growth was also stable, as higher trade and consumer loans were offset by lower non-trade corporate loans. And notably, the City Taiwan consolidation also contributed around 10 billion Sing dollars to loans. The second positive is that their fee income has continued to recover strongly. It rose 31% year-on-year to around 867 million. And this was mainly due to a broad-based growth in all segments in their loans. So their wealth management fees increased. Their card fees also grew strongly, mainly from higher spending as well as the integration of City Taiwan. Loan-related fees also rose, and investment banking fees were also up. However, these increases were moderated slightly by a 4% year-on-year decline in transaction fees as trade finance slowed. The third positive is that their other non-interest income rose 9% year-on-year, mainly from higher treasury customer sales as well as gains from investment securities. Now, for the negatives, the first negative, as I mentioned earlier, was that their allowances rose 438% year-on-year. So while this figure might seem quite large, this was mainly due to the normalized general provisions of 3 million compared to the write-back of 116 million a year ago, as well as higher SPs of specific provisions of 139 million compared to 74 million a year ago. As a result, their fourth quarter credit cost rose to 11 basis points, with full year credit costs at also 11 basis points. So this has come in at within their guidance, and also this is actually lower than it was pre-COVID. For the second negative is that their current account, savings accounts or CASA ratio continued to fall, and it fell 8 percentage points year-on-year to 52.3%. This is mainly due to the high interest rate environment as well as a continued move towards their fixed deposits. But as the higher fixed deposits sort of offset the lower current account savings accounts, their total customer deposits did grow by 2% year-on-year to 535 billion. There was also a contribution of 12 billion Sing dollars from the City Taiwan consolidation. Now, for the outlook, we feel that their capital position and liquidity are well above their regulatory requirements as well as high allowance reserves. We believe that the DBS does have the sufficient provisions to ride out current economic uncertainties. Their CET1 ratio rose 0.5 percentage points quarter-on-quarter to 14.6%. And this is still at the upper end of DBS's target operating range of 12.5% to 13.5%. As I mentioned earlier, their dividends were raised 29% year-on-year to 54 cents. And if we were to include the bonus share issue, which they announced, as well as that their dividends are to be maintained at 54 cents per quarter, we are looking at an increase in the DPS by 24% year-on-year for FY24. For their fee income recovery, they do expect that the China's reopening will benefit the regional operating environment as well, and they have also seen an uptick in momentum and business volumes. There's also further upside from their cards spending from higher spending due to the ongoing recovery in travel, and continued momentum is expected in wealth management. And their wealth management AUM did grow 23% year-on-year to a record of 365 billion. They are guiding for double-digit fee income growth for FY24. Lastly, for their net interest income as well as their earnings guidance, they have maintained their guidance which they provided in the previous quarter, with net interest income to remain at the same levels as FY23, as NIMs will be maintained at FY23 exit NIM level, with a possibility of a few basis points drop. So we might be looking at around 2.1% for the NIMs. And the net interest income will be supported by the full year impact of the Citi Taiwan consolidation and some trade-off between net interest margins and loan growth, with the guidance of a low single-digit loans growth for FY24. As a result, they are expecting for PATMI to be maintained at around the current levels in FY23. So we maintain a buy with a lower target price of $38.90 as we lower FY24 earnings by 1% due to lower net interest income estimates and higher allowances and OPEX estimates, offset by higher fees and other non-interest income. The stable net interest income from recovery in loans growth as well as double-digit growth in fee income will sustain DBS's earning momentum. Now moving on to Silverlake. Silverlake Axis also released their second quarter FY24 earnings, and it met our estimates with the first half earnings at 49% of FY24. And there was a 5% year-on-year dip in earnings, and it came from lower than expected non-recurring revenue and higher than expected OPEX. Now straight to the positives. The recurring revenue rose 4% year-on-year, and this recurring revenue comprises of the maintenance and enhancement services, which is the biggest bulk of their revenue, and insurance ecosystems as well as their retail transactions. So their maintenance and enhancement services grew by 2% year-on-year, and this was mainly from revised maintenance rates for some clients upon maintenance renewal, as well as new maintenance revenue recognition for projects that have been completed successfully and handed over to their clients. For their insurance ecosystem, it rose by 15% as there was broad-based growth across all segments, and they do see that this insurance ecosystem will continue to show strong growth. And lastly, their retail transaction processing revenue grew 18%. This was mainly due to the increased usage and subscriptions to the new modules for their cloud-based retail solution, Agora Cloud. The second positive is that their order backlog remains healthy. So they currently have a project pipeline of 1.4 billion ringgit with contract wins of 114 million in the second quarter. So they have seen contract wins of over 100 million ringgit for the last few quarters really, and it's looking to sustain at this above 100 million range. They also have an order backlog of 790 million ringgit going to the rest of FY24. For the negatives, their OPEX rose by 9% year-on-year. This is mainly due to annual salary increments post-pandemic, which was effected in the third quarter of FY23, as well as new headcounts added to support business development and expansion. So they did mention that it's currently quite hard to retain their talent and their staff because of the current environment. So they are having to increase their OPEX slightly. So for the second negative is that their non-recurring revenue has fallen 4% year-on-year, and this comprises of mainly of their software licensing, software project services, as well as the sales of their system software and hardware. So the sale of system software hardware is quite seasonal. It really depends on whether or not there's any new upgrades released. But I think the software licensing, that's the main reason why this non-recurring revenue dip, because there was this shift towards the cloud-based systems such as Mobius and Symmetry, which do not see as much initial revenue recognition as compared to their core legacy system like the SIBS. So for the outlook, we see that as I mentioned earlier, they are shifting towards more of the Mobius and Symmetry cloud-based systems. So while the initial revenue might be smaller, we do expect it to improve their recurrent fees. And as these cloud-based systems avoid the need for banks to purchase and manage hardware assets, this is why their initial revenue is lower. But there will be a need for continuous enhancements and maintenance of these systems, which would improve their quality of the order book, with the bulk of growth coming from their recurrent fees like their maintenance and enhancement fees. The second point we see for the outlook is that we see visible growth from new product cycles, and they have collaborated with this is a very big Thailand bank, and it has shown the proof of concept, and they've also managed to land this multi-million 10-year core and channels digital banking Mobius deal with a client in Malaysia. They've also mentioned an imminent deal with a Thailand bank for Mobius worth around 30 million ringgit. So as such, we maintain a buy with a lower target price of 36 cents. Our estimates remain unchanged, and our target price is currently pegged to 19 times PE. And in our view, Silverlake should trade at a higher premium to its historical PE, which is at 18.4 times, with a new product sales cycle underway from its cloud-based Mobius and Symmetry, as well as the resumption of bank IT spending after the pandemic. So that's all I have for Silverlake. Let me move on now to the banking monthly. So the first one, we were looking at the interest rates. The interest rates has dipped in January, and it dipped by 5 basis points year on year. So this is the largest month-on-month decline since July 2020. And it was down to 3.69%. But nonetheless, you look year on year, it has risen by 64 basis points year on year. However, it is lower than the 5 basis points lower than the fourth quarter average of 3.74%. For the HIBOR, it's quite a similar story, also declined in January, but it was down 55 basis points to 4.82%, the largest month-on-month decline since January 2023. Now moving on to the loans growth. For the loans growth is rather positive. We have seen that while it is still declining, it has fallen by 2.44% year on year December. And this is actually the smallest decline recorded in 11 months. So we see some sort of recovery in the loans growth. For the business loans, it fell by 3.92%. Again, this is also a smaller figure than the last few quarters. And consumer loans were flat year on year. So this is one of the first times you saw it this year that it's flat, as the housing loans sort of picked the other segments back up. So it grew 1.34% year on year. For the total deposits and balances, it grew by 4.29% year on year. And more importantly, the current account and savings account proportion was also maintained at 18.5%. So we're seeing it hovering around this 18.5% range for quite a number of months already. For Hong Kong loans growth, on the right, we see this at the chart. The domestic loans growth has declined by 3.58% year on year and was flat month on month in December. And the year-on-year decline in loan growth was lower than the decline of 4.3% in November. So we are seeing the Hong Kong loans growth has actually been in this decline for almost more than a year now. Now moving on to the SGX statistics. So for the SGX statistics, the securities daily average volume, or SDAV, for January dipped 20% year on year to 924 million, while the derivatives daily average volume grew 5% year on year and 10% month on month in January. The VIX, which is a market index that measures the implied volatility of the S&P 500 index, so we look at it to see the volatility. It averaged 13.4 in January, and this is up from 12.7 the previous month. But however, this is still the second lowest that the VIX has reached since December 2019. The top 4 equity index futures turnover saw an increase of 22% year on year in January, and this was mainly due to higher trading volumes of the FTSE China A50 index futures, as well as the FTSE Taiwan index futures. Now moving on to the next slide. The slide before, So I think there's going to be quite a few queries and questions on the banks, the dividends, because especially after DBS announced such an increase, right? So I broke it down and I did a short slide. So the DBS dividends, let's just go through it again. It's FY23 is at $1.92, and this is actually an increase of 28% year on year, excluding, of course, special dividends in FY22. So for FY24 guidance, they maintain it at 54 cents per quarter, which is $2.16. But if you do include the bonus share, 1 for 10 bonus share issue, the dividends will be at 2.376 cents, which is plus it is risen by 24 cents year on year compared to FY24 to FY23. So if we assume a share price of $33, the DBS will be trading at a 7.2% dividend yield. And what does this mean? Because for the other two banks who have yet to release their results, UOB is on 22nd Feb and OCB is on 28th Feb for those who are interested. So UOB will need to increase their FY23 dividends to $2, which is a 48% year-on-year increase to reach this 7.2%. And OCBC will need to increase it by 38% to 94 cents. So the estimated dividend payout for them to reach this 7.2% will be 57% and 60%. So honestly speaking, it's not that far off. And you know, OCBC also has a higher CET1 ratio and more capital so not more capital, but like higher CET1 capital ratio than DBS. So this is quite a high possibility actually to see such to see the other two banks actually follow DBS. So we have also added a new segment here, which is the Singapore banks performance. So we will look at how the banks have performed in January of this year, so for Jan. So all three local bank share price has actually dipped in January, and UOB was performing the best with the smallest drop of 0.3%, and OCBC also close behind at 0.8%. And DBS was the worst performer with a decline of 4.6%. This is mainly due, best guess is mainly due to the repeated and prolonged digital services disruptions they faced in 2023, which caused the MAS to impose the 6 months restriction on them, where they can't even have any acquisitions. So that might have been the reason why it performed badly in January. So now, next slide, please. Yeah, so we remain positive on and maintain overweight on the banking sector, and the NIMs may see some flat growth despite the higher for longer interest rates. But a recovery in loan growth and fee income will uplift profits. The bank dividend yields are also very attractive now, with upside surprises due to the excess capital ratios as well as a push towards higher ROEs. So that's all I have for the banking sector. I'll now hand it over to Meow Meow. Thank you.
Thank you, Glenn. So Far East Hospitality Trust released their FY23 result last week. Results are mostly in line with our expectation, but DPU surpassed its forecast by 7% on the back of the 8 million distribution of divestment gain of Central Square. So DPU increased by 25% year-on-year. Something positive about them is recovery is on track. ADR surpassed its pre-COVID level, but occupancy slightly lags behind. Thus, RevPAR lands at 95% of pre-COVID level. We expect RevPAR to continue trending upwards in FY24, with more support from second quarter onwards due to seasonality. Contribution from corporate travelers will also decrease, potentially driving ADR higher in the absence of corporate discount. Occupancy is forecasted to ramp up in FY24 due to major events such as Taylor Swift concert and Singapore Air Show in 2024. Far East is one of the least geared asset REIT with leverage ratio of 31.3% and debt headroom of 900 million. But they identified limited growth potential in Singapore due to tight spread between funding costs and asset yield. There's no near-term plan for acquiring more stake in Sentosa since the ticket size is very large and equity fundraising is off the table. The focus is still remain on the low interest rate countries such as Japan, with possibility of acquiring sponsors asset in Tokyo and a positive carry of 2.5%. As for negatives, the cost of debt for FY23 was 3.3%, and Far East expect the rate to increase to around 4% in FY24 when hedges drop off. And for outlook, Far East doesn't expect any increase in supply to add on pressure to RevPAR, as supply comes mainly from the higher-end hotels, and Far East caters towards the middle-tier corporate and leisure travelers. And all hotels have concluded their government contracts and are ready to make full contribution in FY24. With the upcoming mega events, and the occupancy rate is expected to remain resilient, as indicated by the surge in forward booking, coupled with return of Chinese travelers due to the 30 days visa-free policy. RevPAR is expected to rebound back to pre-pandemic level. So Far East is now trading at FY24 dividend yield of 6.8% and 0.7 times price to NAV. We expect revenue to be supported by RevPAR recovery and potential inorganic growth. As such, our DDM back target price remain unchanged at $0.79, with projected FY24 to FY25 DPU of 4.35 to 4.45 cents. That's all for me. I'll hand over to Darren. Thank you.
Yeah, thanks, Mel. Yeah, so an update on class. On Ascott, yeah. So their results basically were they exceeded our expectations by about 10%. That's mainly because they had a one-off foreign exchange gain. So if you strip that out, the results are mostly in line. Yeah, so for the positives, their fourth quarter RevPAR continues to grow. So grew 4% year on year, even despite the higher base, it continues to grow. And the China and Vietnam performance continues to improve, and 86 and 88% respectively already. So we expect this to fully recover within the next 2 years, especially with China reopening and picking up pace. So for the portfolio valuation, it increased 2% despite the higher discount in cap rates, mainly because of the better operating performance of all the assets. And Class is also divesting Citadines Mount Sophia, and the price stayed at 19.4% above book value, and it's at an exit yield of 3.2%. So they have a history of divesting assets at an exit yield of about 3 to 4%, while they're acquiring assets around 5 to 6% EBITDA yield. So that's a good spread for them. So for the capital management front, it's still very healthy. The cost of debt is at 2.4%, but we expect it to increase to around 3% in FY24 this year. And the gearing is also healthy at 37.9%. So there's no risk of breaching MAS leverage limits or whatsoever for now. So for the outlook for Class, yeah, they are focused on portfolio recycling. So like I mentioned, divesting assets at a exit yield of 3 to 4% and acquiring at about 5 to 6% yield. And international visitor arrivals also expected to pick up. And right now they have about 300 million in divestment gains that are sitting the books that they've yet to pay out. So likely they'll start paying out, especially when there's a downtime, especially like when Keppel DC London, their AEI project will be closed for renovation in the fourth quarter this year to next year. So due to the share price performance, we downgrade to accumulate from a buy rating, but we unchanged our target price to at $1.04. So Class is paying a forward dividend yield of about 6.5% for now. Next slide, please. Next is Keppel DC REIT and an update on the results. The results were under our expectations, mainly because of the non-collection of the rental in arrears from the Guangdong data center. So that's the highlight basically for the results. But for the positives, the portfolio occupancy remained relatively stable, so it's 98.3% unchanged. And they also noted that the leases were signed at positive rental reversions. The capital management front is also quite healthy, gearing 37.4%, and the cost of debt is at 3.5%. So another positive for them is that just last week they announced that they had a positive resolution to the DXC litigation that's been going on for about 2 to 3 years. So they've settled out of court and they'll be receiving 13.3 million from DXC to be paid by April 2024. So this is an immediate positive upside for them. So for the negatives, like the big thing for them is that right now they have rentals that are owed by the master lessee at Guangdong data center. So right now they owe about 5.5 months of both coupon income and rental income that's supposed to be paid but have not been paid for FY23. So right now they only settle about 0.5 RMB out of 48.3 million. So this is a very small amount. So we expect Blue Sea to kind of default on their payment and not be able to pay rent. And Keppel DC will have to eventually replace Blue Sea. So there will be downtime for these Guangdong data centers in FY24. So we have accounted for all these downtimes in our model. But for the outlook, for Keppel DC REIT, the demand for data center space is still strong due to all these factors like AI, cloud computing, generative AI, big data, IoT, and such. So with that, we downgrade our call from buy previously to accumulate, and with a lower target price of $1.86 after we account for especially this Blue Sea tenant replacement and such. So Keppel DC right now is paying a forward dividend yield of about 5%. Next slide, please. So now I'll run through the Singapore REITs Monthly. So for the month of January, the dividend yield spread for the Singapore S REITs right now is at 3.2%, It's risen slightly due to the share price, the share price, it rose by almost 15% in the last 2 months of 2023. So in 2024, it was down about 4.4%. So because of that, the dividend yield spread ticked up slightly. And we expect this dividend yield spread to increase over the course of the year as the interest rates drop, and the bond yields will likely follow suit and decline as well. So that will raise the dividend yield spread. Yeah, next slide, please. Yeah, so right now the forward dividend yield for S-REITs is at the 10-year average, it's at 6.1%. So we think this is a good level, it's an attractive level for us. But right now, it still can't compare to, like Glenn mentioned, the DBS is already paying 7%. So yeah, but we think this 6.1% based on historical average is at a good level for REITs. And right now, price to NAV for S-REITs is at 0.9 times. So this is also 1.4 standard deviations below the 10-year average. So this is valuation standpoint is an attractive to enter into REITs now. Yeah, next slide. Yeah, so this is our subsector preferences. We still remain overweight on the hospitality sector. As you can see from the results of FICE, the Mel mentioned, as well as Class, all of both companies reported a good set of results and a growing DPU. So we think this will likely continue, but the fact is that because of the higher base in 2023, we expect the RevPAR growth to soften to perhaps a single digit or a low double digit growth in 2024. Because we saw that 2023, from the low base in 2022, we saw some RevPAR numbers grew triple digit year on year, so we expect that to slow. Yeah, it's good. So you see here visitor arrivals is 50% up, but it's still 15% below pre-COVID levels. So we expect this to pick up, especially with this China visa-free 30-day entry into Singapore. So we expect this to pick up, and this visitor arrivals growth in January was boosted mainly by Coldplay in the last 2 weeks of January. Hotel RevPAR, it is down year on year from higher base, especially from the high average room rates. But we expect this to grow as well, especially we see in March, for example, Taylor Swift, during the dates that she's in town, the average daily room rates are already 20 to 30% higher or even more. And we expect the occupancy to be almost full as well. So that was the case with Coldplay when they were in town as well. So, and there's quite a solid lineup of MICE events as well as the Singapore Air Show. So all this will help to boost Singapore hotel RevPAR going forward. Yeah, so we think this sector will also continue to be able to generate a DPU growth as does the same thing happen for 2023 in 2024. Yeah, next slide. Yeah, so we also like retail cost is for its resilience. Although we see December numbers, the retail sales index is down slightly, but we all know the budget that happened last Friday, the Singapore budget. We saw that there's an enhancement to the assurance package of $1.9 billion. So there are a lot of cash payouts, NS Life credits as well. So all this will help to kind of boost the retail sales in FY24. So we see retail sales being very resilient in FY24. And this will help to support the positive rental reversions going forward, where we expect suburban malls to have a good set of rental reversions, like mid-single digits, and while downtown malls will perhaps have a higher single-digit kind of positive rental reversions in FY24. So yeah, because of this resilience tenant sales that we expect. Yeah, next slide, please. Yeah, so this is a snapshot of some of the REITs which have already declared their results, full year results, and had some rather they had declared their DPU year-on-year growth. So yeah, we can see here about 75% of the REITs, because of higher interest rates, they were not able to generate a year-on-year DPU growth, with the exception of hospitality. So you can see the top 2 REITs, yeah, with double-digit growth. That's because of the hospitality sector performed well, and they could more than offset the rise in interest rates. Yeah, so this is just a quick snapshot. And at the bottom, we see Manulife and Keppel Pacific Oak. Yeah, because of the struggles in the US commercial market, there's no the banks are not willing to lend. So in order to conserve capital, last week Keppel Pacific Oak US REIT, they decided to halt their distribution and conserve capital to fund capex needs and such. So yeah, so that's the downside for this US office REIT. So Prime US REIT will be releasing the results in 2 days or rather 3 days time. So we are wary of that as well. We think there might be some sort of similar situation where because they've not released their valuations, their year-end valuations. So because of this year-end valuation impact, we think that their gearing might be hit. We are still uncertain whether it will cross or rather breach the debt covenant limits or the MS gearing limit. So we think they will take these proactive measures to prevent that from happening. So it's possible that they might do some sort of a recapitalization plan as well. Yeah, so we'll keep a lookout on that and we'll update next week on the Monday webinar. Yeah, next slide, please. Yeah, and this is our coverage and just so basically this is our stock coverage. Nothing much to say on this slide. Yep. Okay, next slide, please. Yeah, now hand over the time to Peggy. Yeah, thanks.
Thank you, Darren. Morning. I'll talk about BRC. BRC gave a first quarter business update. We're maintaining our target price on $1.99, but we move our recommendation down to accumulate, mainly because of the recent price appreciation. Okay, some brief highlights of the first quarter numbers. Revenue was up 17%. It's about 20% of our full year forecast. Because this is typically low quarter with a rainy season, so the numbers we think is in line. They had higher volume this first quarter this year compared to the year before because construction really picked up in 2023. But average selling price was down. We estimate about 17% during this quarter. They also benefited from an absence of losses from associates, and we believe it's also a result of lower interest expense as they managed to move their debt level even lower. The gross margin improved 2 percentage points. This reflects the higher utilization rate as the volume increased, and being a market leader with about 80 to 85% of the market share in Singapore for rebars, the higher volume really flowed all the way down to the bottom line as they enjoy operating leverage. And during this period as well, they also see a lower freight cost. The net debt is about the same level as September last year. Despite the jump in sales, so when that suggests a healthy working capital for them, and we so far don't see any collection stress. The lower steel prices also help to free up the trade financing needs, and therefore helps them to reduce their gearing level to 0.5 times at the end of December 2023. The order book is stable at 1.3 billion. 2024 outlook is rosy. Construction contracts awards in 2023 rose 30.4%. So this will translate into job completions in 12 to 18 months after that. And steel prices we think have bottomed. If the raw materials prices, if their materials costs were to go up, and they typically can pass on to the customers through the fluctuation clause monitored by the BCA. They will be able to improve on their gross margin further from the 8.9% currently. And they also have not booked in a 14 million gain from the sale of Maldives assets. If these are so, which the completion is expected to be in March or April. So with this 14 million profit, which we have not assumed in our forecast, with the 40 million gain, they will be able to pay out about 5 cents more dividend according to our estimates. So we are maintaining our target price and at $1.99. The yield before this special dividend is already at about 8.7%, much above the banks, DBS especially. Yeah, thanks. Move on to the next company. United, yeah, another building materials providers. They are in the ready-mix concrete with a market share about 40%, another market leader in this segment. We're maintaining a buy call with a raised target price of 55 cents from 50 cents earlier. The results were 6% above our estimates. They enjoy higher average selling prices. They managed to move up the selling price by 5%, according to our estimates, versus the standard 1% improvement in the entire market, mainly because they had this low carbon solutions, which they are able to command a higher price. And volume also at the same time during the year was up 5%. The growth especially accelerated in the second half. Revenue in second half was 15% higher, half and half, and net profit was 30% higher. Besides the improved in product mix, the gross margin was also strengthened because they did a lot more work for HDB. As HDB also ramp up the unit launches. For HDB, they don't provide the materials, they only provide patching services. So this is a service revenue that flows directly to the margin and no working capital requirements. ROE therefore improved to 16.5% compared to last year of only 11%. This is even in spite of the net cash that they have in the balance sheet, about 43 million. The net cash is really expected to improve further in FY24, despite having to spend another 40 million in capex. We don't see anything negative about this set of results, and the net profit surged 56%. Similarly with BRC, it will also enjoy higher construction activities, which will translate into more progress payments in 2024. And about 60% of these projects are public sector projects, so the risk of customer default is low, and order cancellation is also minimal. The higher carbon tax will benefit them, as the customers will be more driven to adopt the low carbon solutions to offset the increase in tax. This will further differentiate the RNC suppliers, those who have this product and those who do not have. So this year, derived target price has been raised to 55 cents to reflect the strong cash flow. Thank you. The next slide will show my forecast for 24 and 25. The forecast for 24 has been maintained relatively, which is marginal increase. The 25, we introduced our 25 numbers, and the dividend yield at 6.4 and 6.7% remains very, very attractive compared to the market. Thank you. That's all for me. Pass on to Zane. Thank you.
Thanks, Peggy. I'll move on to the technicals. So looking at the S&P 500 last week, we saw a pullback from the main uptrend channel resistance at the 5,040 points area. So this is actually quite a key resistance, given that it has acted as a key reversal point back in July of last year, when it also tested this channel resistance. So I think for this week, we could see a further pullback ahead, given the price action we saw last week, where there was a dip towards 4,920 before a bounce. And then on Friday, there was also a dark cloud cover, bearish candlestick. So I think for this week, we could see further pullback towards a retest of the lows we seen last week. Yeah. So for S&P 500, the immediate resistance is likely to be at 5,030 to 5,060 area, while the immediate support is likely to be between 4,845 to about 4,920 area. Next slide, please. Yeah, so the next one is a technical buy for AEM. So there are signs of this counter is starting to form a bottom. So the technical buy is at 270 with a take profit level at 295 as well as 315. Stop loss can be placed at 256 and the stop loss goes at 276 on Friday. So for AM, looking at the chart, recently has formed a double bottom at the 256 level. And then also another positive is that it has broken out of the neckline resistance, which is at 269. So I think with that, the stock could move higher towards these two levels, given that also further bullish signs as the fresh bullish crossover on MACD, as well as when you look at the RSI, there's also bullish divergence form where it formed a higher low when price actually was forming the double bottom. Also it's also showing increasing momentum as well. Yeah. Next slide. Yeah, so this is just a summary of the trade initiated. Currently it's in progress and it's up about 2%. Yeah. So that's all from me now. I'll pass on the time to Paul to talk about Starhub. Thank you.
Yeah, thanks, Dean. Sorry, my camera. Yeah, so for Starhub, the main highlight was actually just the dividends. If you look at the dividends full year, if you look at the first point results, full year dividend was 6.7 cents, a 30% jump compared to they were guiding 5 cents, so everybody was just expecting 5 cents, but they raised it up. So in terms of, so that was a positive because what they said is that they can pay 115 million of dividends with a free cash flow of 186. But technically, free cash flow these days, because of the change in accounting, you should also remove the lease payments, but they didn't. But even then, you're still getting like 150, so that's why they're willing to pay higher in terms of dividends. The negative is just slow growth. So if you look at the mobile, which is their main revenue and the biggest margin is mobile, but surprisingly, it's been sluggish even with roaming revenue, because roaming revenue technically is like almost pure profit type of revenue. But even with the opening of borders, you didn't really get that kind of big uplift. And if you go down the outlook part, you can see that their guidance has been cut. They were guiding 8-10% growth, then 3-5%, then now 1-3. Our forecast is 2, just to be in the middle. Then so for in terms of outlook, we still think there will be some improvement in earnings, because if you recall, they are going this major 300 million capex and opex spend called DARE Plus. It's going to end mostly by end this year. Then next year you should have some growth. So these are a lot of upfront costs that they're taking on. That's why if you look on the table on the left, you also notice the margins jump up a lot. But that's mainly because the last quarter they had some one-off costs that they were incurring. They didn't strip it out, so we also didn't strip it out. So that's why you see such a strong growth. So for this stock, you are collecting maybe 6% dividend yield. Don't expect much growth, but there are some re-rating catalysts. So the first one is that if their investments pan out and they start to have lower costs and improve the margins and revenue, so far I don't see anything yet, but if they actually does happen, then you get this re-rating. The second re-rating is, of course, if they can some path to monetize Ensign, which is a jewel in their business, the cybersecurity. And the third, if there's some consolidation in the industry, I think every quarter everybody asks us the same thing, so they also can't say. But all they say is that they are ready if there's any consolidation. Next slide. So for Thai Bev, the title is no celebration yet. So this is an update. So Thai Bev don't give any briefing. They just throw some revenue and some EBITDA numbers and take care on it. It's up to you to decipher. So for us, it's basically in line with our forecast 26-27. The positive is really the margin improvement. So even though revenue was down, you can see on the left 6%, the EBITDA actually did improve. They weren't very explicit in what was the driver, but we think production costs, and they are also cutting a lot of A&P. So the negative, as per the negative, the last 4 quarters continues to be the beer business. So you look at the table on the left, the beer volumes is down 15% year on year. And they are in the teens for the last 4 quarters. So mainly a lot of it is due to Sabeco. So in terms of the outlook, why we still have a buy? So this is really a macro call. So it's not that we think people are going to drink more beer or the market share is going to increase, because they already have a 90% market share in spirits. But mainly because we think the Thai government is really firm on trying to stimulate the economy. So you look at the bullet point next, they are going to have fiscal stimulus. They cut excise tax on alcohol. There's a possibility, not clear yet, but there's a possibility they're also going to remove some prohibited drinking period, if any. So that I'm not sure who drinks 2 p.m. to 5 p.m., but they're trying to remove that too, so that it can help tourist spending and all that. So that's the main driver is for us. Why we have a buy is because we think the macro conditions will improve. Since it's quite poor now. The second point is that, but don't expect much from Sabeco, which is the Vietnam beer business yet, because in the recent call, they said that the Tet, so Tet is like their biggest festival, is actually Lunar New Year too. So they say that sales in Vietnam for Tet is still sluggish, is because of the weak macro environments in Vietnam. So a lot of the distributors and retailers are not willing to stock up, because beer, you have to keep it fresh. So a lot of them are just very cautious, so they're not stocking up as much as the previous years. So we still think the March quarter will still be another weak one for Vietnam. So in terms of how we see this stock, since you always get a lot of questions, is firstly we think you have to rely on stimulus by government Thailand, so that will bring that stock up in our own sequencing of events. Then second part will be, of course, Vietnam will be will recovery in Vietnam. But do take note, I think the whole consumer sector, not just Thailand, not just Thai Bev, but the whole consumer sector has been derated. So valuations are collapsing. Thai Bev used to trade at 18, almost 20 times. Now you're looking at low teens. Because consumer demand in emerging markets, talking about Philippines, are all weak because of inflation, the weak exchange rate. So that's why you have this major derating. And even the Thai market is also down. So the whole emerging market, Southeast Asia market is all derated. So that's one of the reasons the valuation for Thai Bev is also under pressure. I mean, this is pretty obvious, but just to remind everyone. Next slide. So okay, yeah, okay, so the budget came out, everybody knows. So this is we had a report on it. So the budget theme was social, healthcare, age, retirement, education. It's supposed to rhyme with share, but okay, I won't run through all the details. But in terms of the comment, compared to the last year's budget, there were two differences. I think the first one was of course, usually they have a cost of living. Everybody get the CDC voucher. Thank you. But I think this time around, they will focus more on the retirees and seniors, like building up the retirement fund for them. So if you look at the bottom here under retirement, that's why they give this big 8 billion push to Majula package. So they're going to boost anyone, I think 40 and above, they're going to just, I think it's 40 above. Sorry, not 40 above, that's the reskilling. So any seniors, they're going to just top up their retirement savings and so forth. Because you must be born 1973 and before. Okay, then the other interesting one was they are going to upskill the workforce. So this was very aggressive. So what they're going to do is that if you look at the bottom here, the education, everyone who wants 40 years and above, Singapore citizens, of course, if they want to do retraining, you get a 4,000 to pay for your course, and then you get like 50% of your pay for 2 years. So in a way, it's almost like unemployment benefits a bit, I guess, Singapore's skew towards co-pay, I guess. The impact, the left here is just the impact to the various sector, but the main one for us was probably power. I think because they're going to spend additional 5 billion on green infrastructure, and they are going to spend on new clean fuels, which is hydrogen and nuclear, which they didn't rule out. But the more critical thing is that for energy security, because they said that they cannot keep on importing clean energy. For energy security, they need to build something in Singapore. And if you talk security, then the two partners will be obviously Keppel and Sembcorp that they'll probably work with to probably hydrogen and so forth. So that is the positive. I think the rest everyone can read through, and it's all over the press anyway. But if you have questions, you can just ask us. But usually budget don't have much near-term impact to the market. But again, we still have to come out with a report. Next slide. Okay, in terms of our weekly, next slide. Okay, so as the usual, the key things was the property. So property is still pretty weak. Generally, the volumes are down. Exports were up, but actually electronics was the soft one. Electronics was actually down, or only up 0.7, and the main one was non-electric. SIA passengers still continue to be double the pre-pandemic rate of 9%. But actually, we do see a recovery in exports, not only in Singapore, but we actually see it in Taiwan. We also see it in Korea. So like third, fourth one increase. The US, I think we discussed it, but the core inflation actually just a bit higher. I think it's not like maybe 0.1 or 0.2 higher than expectations, and the market already reacted. But the one a bit more worrying is that the retail sales is actually slowing back down in the US. Of course, it's just one number, but you see a few more points, then it's on track for our expectations that the US economy is going to slow down. Next slide. So in terms of tactical views, so bond yields or interest rates actually are at the year highs right now. But I think that as per one of the questions mentioned, what happened is that inflation is trending down, we think, but it's just higher above expectations. So there were two things here. Firstly, of course, CPI. Then number two is PPI was above expectations. It's still trending down just a little bit, maybe 0.1, 0.2. And also one of the FOMC members said that they are not comfortable that the inflation is going to hit their 2% yet. So all this, of course, is going to put a lot of pressure on bond yields, pushing interest rates higher. Of course, negative for REITs. And the more worrying thing is that by the month end, as you know, there's the Fed's preferred inflation, the so-called PCE, that comes out month end. So unlikely you're going to see much of a decline. So all this is going to, so this hot inflation numbers, CPI, PPI, PCE, not to confuse everybody, this is all going to keep interest rates high or expectations that it will remain higher than expected. Okay, in terms of opportunities, we think Elite looks interesting for us. I know probably not much appetite for overseas REITs, but after what happened to Corp, but because the UK inflation now is at 2-year lows, and there's a chance for a rate cut that will support valuations and the attractiveness of their 13 or 14% yield. The other observation we had was that even though Applied Materials is one of the major customers for UMS, so although Applied Materials guidance for the next quarter was actually revenue is going to come down 2%, but actually the stock still rally. So what we think is happening is that the whole semiconductor supply chain is being re-rated because of AI. Likewise for the Singapore ones, our preferred is semiconductor stock is actually AEM. For only one main reason, because their customer, unlike the rest, actually guiding for stronger growth. So Intel is guiding for stronger capex, which will benefit AEM. Whereas you can see Applied and all that, they're still quite sluggish. Even ASML's guidance is also flat. Whereas the difference for AEM is that their customer actually guide higher spending, so this will benefit them. Then of course for Core, my own view is that it's interesting stock, but maybe not now, but actually they're being penalized, rightly so, of course, but they're actually reinvesting into their own business to defer the DPU to 2026. Because, capex is crucial. These days, if you want to attract tenant, you really either have to renovate, otherwise no tenant is going to come. But the timing is going to be unclear, but the thing is that they actually could pay dividends, just that they took the dividends and put it back into the business. Okay, anyway, some of the key events, a lot of results coming out. We got Sembcorp, SIA, I think for everyone to see here. Then for this week, we have OUE REIT. If anyone, feel free to join. It's open to anyone. You just go to our Poland's website. Thank you. Next slide. Okay, so this is so on the left here is to show the weakness in the property. So property sales new launch is actually pretty weak. You can see here the momentum. This is the 12-month momentum is compared to the red line, which is the average. On the right is just the SIA passenger volumes, so 3-month moving average. Next slide. Okay, this is just the exports. You can see everything is picking up pretty sharply, except the red line here on the left, which is Singapore electronic exports. Next slide. Then here is just inflation. I know the one on the left is very confusing, but if you break this, just the main one is the red line, of course. So inflation is coming down. What's holding up is services and shelter. Shelter is the black line. So this is the press like to call it the so-called last mile of inflation. But again, for us, the key thing is the trend line is still down. And the UK inflation is almost more than a 2-year low. Next slide. Then, okay, this is just Applied. So on the left is Applied's revenue. So if you look at the red line, so you will notice that why the semicon stocks did so well during the pandemic. Everyone's revenue, like you look at Applied, used to have a quarterly revenue of 4 billion to 4.5, then spike up to 6 to 7 billion. It's still holding well there, but the growth rate in the red line here is only like 0 or -2%. The only good thing for Applied results was the inventory is trending down. Yeah, okay, I think next should be, that's it. I think, because our briefing today is very long. Okay, Ken, I think we can move on to questions. I think there are 45. Yeah, okay.
Yeah, thanks, Paul. Let me take a few.
Don't need to go, yeah.
Yeah, sorry, Glenn. I'll take a few on the US side. Yeah, so the first one is your slide, the target price for NVIDIA is 645 and you have a buy recommendation. As a share price, last Friday is 726. Is it still a buy? Yeah, actually, sorry, there's an error there. The target price is actually 685, not 645. But either way, it's still below the last close share price of 700 plus. But in essence, the reason why our target price is 685 is because, and why it's a buy is because when we last did a report, which was after their third quarter earnings, I believe the stock price was at 470 range. And so because it's the new year, a lot of target prices have started going up because a lot of analysts have rolled over their valuations and so on. But if you look at the overall business, it's definitely still a buy right now. If you look at some of the forward valuations right now, I believe it's trading about 35 times for PE, which is high relative to the S&P 500. But if you look at how fast they're growing and how fast revenue and earnings are growing, it seems a lot more of value compared to maybe a year ago in the beginning of last year. We still think that demand from AI is gonna impact them directly, very positively. And generally as a business, as long as you have demand that outstrips your supply, should be quite well positioned for a lot of share price gains, and that's what we're seeing. Right. So long story short, yes, still a buy for us. There's another question related to this, and that's what do we expect in the upcoming earnings? So I believe they guided to about $20 billion, which is like 230% year-on-year increase in revenue, which is quite crazy. We do expect them to actually exceed this, but slightly. Maybe not by much, but we do expect slight outperformance on both top and bottom lines, just because demand has been so strong, and there hasn't really been any red flags for any sort of slowdown. So definitely we still expect a very strong set of earnings to come up. And if you just take a look at its main competitor, right, which is AMD, they issued really good guidance and really good earnings as well. So we're kind of taking cue from that as well. The next question is, I thought Meta's a buy. It's like, yeah, sorry, it's a typo. It actually should be an accumulate. We downgraded it from buy to accumulate in this latest earnings release. There's another question on Tesla. So there's another question on Tesla and BYD. BYD said it's launching high-end luxury models from this year. I think it's called the Han line. What's the impact to Tesla, or not much impact since Tesla cars are getting cheaper? The follow-up is BYD also launched a new plug-in hybrid at 80,000 yuan. Yeah, so actually BYD, I believe they're launching their new line at about 230 or 240,000 BP, which is very close to it's maybe 20,000 RMB or less cheaper than a Tesla Model 3. So it's very similar in price, although I guess it is a higher end model. So Tesla's Model 3 isn't technically a luxury model. Although we think that and for consumers in China, price actually plays a significant difference compared to they're not as brand loyal as maybe consumers in Singapore are, or consumers in most parts of the world. So they're really going for cheaper prices. So we think that for its China business will definitely see an impact. It remains to be seen whether Tesla's going to continue cutting prices, although we do expect some sort of price cuts for this year, although not as significant as last year. So the impact will be the same thing, being a headwind on margins, and that will really be the main bulk of impact, which is kind of baked into a lot of the valuation for Tesla right now. I mean, it's competition not just from BYD, but also from like NIO and all the other things as well. So we still think it will still have a negative impact and a constant impact, although nothing that is too out of the ordinary, and nothing that hasn't really been baked into a lot of the valuations. Yeah. So hope that helps to answer those questions. Maybe I'll hand it over to Glenn. Take DBS. Thank you.
Hey, thanks, John. Yeah. Okay, I think I have quite a few questions. Let me just slowly go through them. Okay, I'll just quickly go through them, sorry. DBS allowances going up so much, is it concerning? So if you look, okay, the allowance only went up year on year so much because the previous year, in 2022, there was a lot of write-backs. So that's the reason why you see this like the 438% year-on-year increase. But I think the figure that we really need to look at is the credit cost. Credit cost is at 11 basis points. So if you look pre-pandemic, we're looking at around 20 basis points. So they've actually lowered their credit costs, which is how they calculate credit costs is specific provisions over their loans, so total loans. So that's how you get their credit cost. So 11 basis points is what they got for FY23, and going forward into FY24, they are guiding for around 17 to 20 basis points. So this is still, I think it's more of a normalizing of this allowances. So it's not really an increase. 70 to 20, I think, is similar to the pre-pandemic levels. Yeah. So I think they have just managed to level off their allowances, and I don't think there's any, apart from maybe the last quarter where they said there was they had to provision for the what was it, the AML issue, right? The money laundering one. Yeah, so that's the only big one, the big ticket that we saw. And then this quarter, there isn't really much. Yeah, so I don't think there's any big things that are concerning for the allowances, at least on the allowances side. Okay, yeah, this question. Do you expect UOB and OCBC to give more dividends, or will they continue to be stingy since DBS has raised the bar? Yeah, I think there's quite a few questions on this, so I'll just answer this one first. I mentioned that earlier in my slide where I said I spoke about how much UOB and OCBC has to give. So I think it's 57 to 60% dividend payout ratio, based at least on our FY23 estimates. So I think, you know, the banks will be, the other two banks will definitely be very pressured to give to increase their dividends, right? They usually follow suit before DBS is done. So when DBS gives a special, and then they will just sort of increase their dividends as well. So it's really hard to say whether they will continue to be, in your words, stingy, but I highly doubt it because they also have a lot of capital which they have to release. You know, OCBC has the highest CET1 ratio amongst the three banks. So I think it's highly likely we could see more dividends. But I think going to the next question, someone asked also, you know, is it possible, let me try to find it. Is it possible for, okay, I need to scroll down, for UOB, yes, okay. So this one, what are the chances of UOB and OCBC giving out bonus shares too in their FY23 reporting? So it is really very hard to say whether they will be giving out bonus shares. I think they would have decided already whether or not they're going to do it, but I guess we just have to wait and see. But I think the DBS one came as a bit of a surprise because, you know, instead of just giving a special dividend, which they like what they did last year, they gave a 50-cent special dividend to boost their payout, but now they gave a bonus share issue. So there's also, I think, one more question which I read briefly is like, why did they go with this bonus share issue instead of just giving a dividend? So the main reason why they gave was because they are trying to increase the base. So, you know, for investors wise, you know, the bonus, special dividends, or even a dividend payout, they can always lower it, you know, if let's say their earnings dip. But with a bonus share issue, you will have the extra one share for as long as you want to hold it, right? So it won't go away, right? And furthermore, if you move ahead when they are giving dividends, you also reap at least 10% extra in dividends. Yeah, so I really don't know. I can't predict whether they will follow suit and give this bonus share. But on the other point, whether or not they will increase their dividends, I think highly likely that they will increase it. Okay, let me just go again. I think quite a few questions. Sorry, I just have to scroll down.
Yeah.
Bonus share. Okay, so this is the question. Bonus share or dividend? Oh, sorry, Paul.
Oh no, I just want to add the reason why DBS is giving the dividends and the bonus share is that so if they so rather than they cut dividends so if let's say they push up dividends very aggressively rather than give you bonus shares, then they always worry if they cannot sustain, then they have to cut dividends. So they just want to keep the absolute amounts the same. So rather than let's say rather than give you $2.20, they just give you $2. Then they just raise the dividends, raise bonus, so that because there's a implicit special inside that, so that they don't have to cut dividends in future. So that's why they're using this mechanism to give bonus. So assuming they keep on let's say it's 50, they ramp up dividends $2 to $3, then cannot sustain, they might have to bring it down. But instead of bringing down the absolute value of the dividend, they just don't give bonus. So that's why they came out with this kind of combination. Why this so strange combination? Yeah, sorry, Glenn, you can go on, James.
Yeah, okay, I think they answered that. Paul also helped to answer the second one where bonus share or dividend is better. One more. What makes DBS able to trade a higher price over book than its peers? I think DBS historically has always done this. It might be because it's, you know, the largest bank in Singapore, and also their digital initiatives. There are many reasons why, but I think being the largest in Singapore is probably one of the reasons. Hold on, let me just go through. Okay, there's one more question. Silverlake looks like a value trap. I wouldn't think so. Silverlake, firstly, they are quite diversified. They do have a lot of, they're not just in core banking, they're also in the insurance ecosystem. They also do a lot of retail transactions. And secondly, you know, their customer base is very, very large as well, not just in Singapore, it's all over ASEAN. And you know, they have a lot of large banks. So I think in Singapore, UOB and OCBC, they are their customers, right? So I don't think their customer base is really just a touch and go kind of thing. You know, they are there to stay, and you know, they have been with them for many, many years. And secondly, they are also looking into to explore, you know, not just based on their SIBS, which is their core legacy. They're also trying to expand into the new technology now, which is the cloud core banking, which they have done so with successfully with Mobius and Symmetry. Yeah, so I don't think that is true. Okay, let me just go through again. Okay, maybe I'll pass it on to the rest of my colleagues first. Yeah, thanks. Oh, sorry, there's one more. Bonus, DBS bonus share, there's likely avenue to round up odd bonus share to the hundreds. Okay, so I'm not very sure. I think you might need to speak to your dealer to ask them like about this. Okay, I'll hand it over to the rest of my colleagues first. Thanks.
Hi. Yeah, thank you, Glenn. I'll take over. As far as hospitality rate of value trap stock, the share price always stuck at 60 plus cents for so many years. So far as hospitality trust, so the unit price is a function of market sentiment and the overhang in the market with regard to the high interest rate. So far as is now trading at 0.7 times price to NAV. And there's only a few REITs who can trade about 1 times price book. So Far East has a limited growth potential, which is because it's limited to Singapore compared to Class and CDL. They have a global exposure. But Far East is actually the best performer among all REITs, which reported the earnings, yeah, in terms of DPO growth. So they DPO increased by 25% year on year, even though they only hedge like 48% of the debt. Yeah, so in 2023, 3 hotels was under government contract, and they slowly came out at the end of 2023. And they mentioned like during the mega events period, RevPAR was able to surge up to 15% more. So with all the hotels back to full contribution, and there's a lines of event this year, we expect Far East Hospitality Trust to have a very good performance this year. And also they plan to grow inorganically. So they plan to expand into Japan. And yeah, as we know from the class performance, RevPAR of Japan actually increased the most, like compared to all other countries. And the asset price is still reasonable, like since they are planning to acquire from sponsor. Yeah, so their sponsor is a developer, so it makes sense like to acquire a cheaper asset from them. So the ticket size roughly is 70 to 80 million. And one thing we would like to emphasize is their gearing is very low, around 31%. So they have debt headroom of 900 million. Yeah, so they won't consider equity fundraising for sure. Yeah, so the operational performance looks promising, and they also have inorganic growth. Yeah, we hope the share price will reflect that in FY24. Yeah, hope it answers your question. And there is also one on Suntec. Suntec seems to be lagging in terms of share price performance post-COVID. What's your rationale for the target price of 1.47 versus the target current share price of 1.17? So for Suntec rate, it's not only trading at 0.58 times price to NAV, which we believe the market didn't price it correctly. Even at our target price of 1.47, it's only 0.7 times price to NAV, which is still below the historical average. Also, market penalized Suntec risk mainly because of the worry of its high gearing. Yeah, and the good operational performance was largely offset by the high financing cost. Yeah, gearing was 42.3% on December 23, but it's already decreased 0.2 for PBT year on year. they are still committed to another 100 million divestment in FY24. So 100 million was already divested in FY23 with the price 31% above the book value. Yeah, so they're putting on effort to de-risking, without diluting the value. And one thing differentiates Suntec from the other REITs is they have a very low fixed portion of the debt, around 58%. So we believe it will benefit the most from the expected rate cutting in FY24. Yeah, so the fundamental remain resilient, and we anticipate strong rental reversion for retail side to be persist in FY24. Yeah, when international travelers returns and office still trending at mid-single digit rental reversion. Yeah, hope it answers your question. Thank you. I'll pass over to rest of my colleagues.
Okay, I think I'll take the question on Amazon. So one person asked, how's Amazon's AWS cloud margins compared to the competitors like Microsoft and Google? So AWS gross margin right now is at operating margin right now is 29.6%, while Google is around 5%. Microsoft, they don't really provide a number, but if you dig a little bit deeper, it should be around 30% as well. So the reason for the huge gap is mostly because Amazon and Microsoft has been there for a longer period. So Google is relatively a new player. So they're currently trying to scale up their business. They're just about profitable on their cloud services. So it's actually very tough to compare. But if you really look into it in the future, Google, they actually focus a lot more customer facing product, so we can actually expect their margin to be the highest in the future. So right now, if you look at the market share, AWS takes about 30% of the market share, while Microsoft takes 20%. Google Cloud only has 10% right now, so they're really just in the beginning stage. Yeah, I hope that answers your question. Thank you. I'll pass my time to other colleagues.
Thanks, Alina. I'll take over. There's a question on Sembcorp. Let me look for it here. I can't find the question. I asked about Sembcorp's results coming out tomorrow morning. What's our expectations? We are expecting a net profit of 912 million. 912 million for full year 23. We are on the lower end, at the lower end of the market estimates. Basically, projecting a softer second half compared to first half, because in the first half they had a forex gain as the rupee appreciated, so they had a forex gain on the deferred payment notes about 38 million. And first half there's also some spike in the energy spark spread, which they enjoyed, but that has been removed in second half as the temporary price mechanism came into play that is imposed by the Energy Market Authority to prevent any sudden spike in energy prices. So we are expecting 912 million net profit to be announced for FY23 tomorrow morning. Thank you. The next question is I think there's a question on what's the on sustainable aviation fuel. I think there's an announcement that from the authority that the sustainable aviation fuel will be introduced from 2025 for the airlines to incorporate 1% of their fuel consumption, and with that they also has allow a levy from 2025 for these airlines to levy on the passengers. The amount that's been levied looks relatively small. It's like a $3 increase, $3 levy for Sing dollar for a flight from Singapore to Bangkok, or a $16 for a flight from Singapore to London. Because the premium seats will have to pay more. Going by the target of 5% having 5% of their fuel consumption to be sustainable aviation fuel by the year 2030. Going by the current price of sustainable fuel, which is about 3 to 5 times what they are paying for jet fuel, the airlines are paying for jet fuel currently. We think this levy might not be sufficient to cover the airlines' costs. So, so the cost, jet fuel price for airlines is likely to go up, and the higher levy might have some impact on the passengers' decision to travel. Especially with the current booking cycles for the passenger business is getting much shorter than before. Definitely very much shorter than before pre-COVID. And it's getting shorter right now, progressively down. This only show just to illustrate that leisure travel is driving the travel demand, and without long-term bookings, airlines are also will find more difficult to plan their capacity growth. But we read across all the airlines, the news, their latest results and announcements. Most of them are putting in more capacity into the Asian markets, especially highlighting China and Japan. So we're expecting a lot more capacity being added into this segment. For cargo is still a largely spot market driven demand. So the numbers there are still, the volume wise is still likely to be fairly volatile and fairly weak. Very difficult to predict the capacity, and that will increase the cost for the operators. And then in the budget last Friday, Singapore also raised the tax for the aircraft leasing company from 5% to 10%. So that means that aircraft leasing companies now have a higher cost on top of the higher interest rates, and they will pass this on to the airlines who are leasing the planes. So this means that airlines operating costs are likely to rise from this year onwards. Yeah. Okay. And there's one more question for me on. I'm not sure what it means by any other long short other than CAO. Okay. CAO is China Aviation Oil. Okay, definitely is it doesn't need a lot of analysis to arrive at our buy call. Just looking at the flight capacities coming into China, the international flights, and the volume of pickup in the international travel volume in and out of China. So it's and the higher fuel prices will definitely benefit them, as well as the use of sustainable fuel, aviation fuel, which they are also participating in. So everything is in their favor, looks in their favor, and then the FY23 results will also benefit from a one-off, from an exceptional jump in the fuel price, a trading income, as in third quarter when the Middle East, the Red Sea crisis happened, then there was a short spike in the fuel price that also benefited the trading income. So China Aviation Oil is still on the buy list. If you are looking at a similar theme, maybe Cathay, I mean those listed in Hong Kong like Cathay Pacific or BOC Asia BOC Aviation might look more interesting. Cathay is trading at 0.8 times price to book, and compared to SIA right now it's about 1.3 times. And yeah, BOC Aviation will benefit from more airlines looking to lease aircraft to bring their capacity up, to raise their capacity. Yeah. I think that's all for me. I'll pass on to the rest first and look at the questions.
Okay, thanks, Peggy. Yeah, so there's one. Do you think Keppel DC REIT didn't do proper due D for quantum data centers? The neo telemedia tenant fundamentals are bad. Yeah, so for this, I can't really comment. So basically, what I think is that when they did the transaction to buy when they acquired the data centers, they definitely did their due diligence, but there's definitely a reason that they did so, because they thought that it was a good acquisition. If not, they wouldn't have gone through with it as well. So they definitely have done their duty. So I can't really comment on that whether they didn't do proper duty, because I believe they did, and they did purchase it for a reason. So it's not like they just anyhow buy the asset. So that's my view. So perhaps the things change. Yeah. So I can't really comment on that. Will Prime become Manulife 3.0? Very scary. All the years of REITs are doing recapitalization. Yeah. So what happened was Manulife, they did the recapitalization because they were forced to do so when their gearing breached the unencumbered ratio of the 60% back then. While Keppel Pacific Core, they did a more preemptive approach where before anything, before they breach any limits or debt covenants, they are taking this preemptive measure to hold their distributions and conserve capital rather than breach really then take action. So for Prime, we think it's likely that they might take some preemptive measures as well. That's definitely depending on whether their valuations breach the limits. But we know for sure for a fact that they will take some action in their results, which is in 3 days time. So I can't really comment whether they will breach and then they'll take measures after they breach, which is like the Manulife situation, or they will do take preemptive measures if they don't breach. So what I'm trying to say is that they definitely will take action, but we still don't know whether they will breach the gearing limit. So right now they have about a 13% buffer in from their year-end 2022 year-end valuations before it hits the 50% gearing limit. Yeah, so we are waiting for results to see that. Yeah, and we think that they might do a recapitalization plan as well of sorts. Yeah. CICT impact high gearing and exposure to China. Is there a chance they also explode like the US REITs? Yeah, so CICT, they don't actually have any exposure to China, but impact they do. And is there any chance they explode like the US REITs? So for China, the operating performance is not so bad, but it's not as bad as the US, because US, the banks are not lending, and basically there are a lot of distressed sales going on and no transactions are happening. The only transactions that are happening in the US right now are from 100% equity buyers, where they are kind of the bargain hunters, where they pick up assets that are really at distressed prices and then they buy it using 100% equity. So the situation in US is, in my opinion, is way worse than in China. So from that perspective also, CICT, they do not have any exposure. MPAC, they have about 20% exposure. So it's not 100% exposure like in the US REITs, where they are 100% exposed to these US poor assets. Like MPAC, they still have some solid assets like VivoCity and such. So yeah, it's different. It's different. So I do not think as a whole they will implode like the US REITs. There's a comment, looks like hospitality REITs looks like only hospitality REITs are safe now. Yeah, so hospitality REITs are safe, but in our opinion, we also like retail because of its resilience, where there's a lot of clarity. Like we know that rental reversions likely will remain positive, and we know tenant sales remain strong, and the rental collection is also relatively is quite safe. It's resilient. So we like these two sectors the most. So we recommend retail for its resilience and positive rental reversions potential, as well as hospitality for the recovery in the international visitor arrivals, as well as RevPAR. Why did CDR Hospitality Trust DPS drop while Class and FESG did so well on the DPS payouts? Yeah, so the difference is that for both Class and FEHD, they managed to have a quite good improvement in MPI margin, or not MPI margin, year-on-year growth in MPI. So FEHD, they had about 25% growth, while CDR Hospitality Trust, they only grew their MPI by about 2.7%, mainly due to a stronger performance in the underlying assets. FEST and CDR Hospitality Trust both have a very low fixed, their percent of debt is very low at about 50%. I think FEST is slightly lower, like Mia mentioned. So that also impacted the distributable income and the DPU at the DPU level for the year-on-year growth. So that kind of hit them quite a bit. CapitaLand and Ascott Trust, their hedging ratio is much higher at about the 70%. So yeah, they were not as impacted as they were not as impacted by rising interest rates over the course of the year. Yeah, so that's why CDR Hospitality Trust DPS dropped compared to the other two. I think I'll hand over to my colleagues for now. I can't find any more. Yeah, thanks.
Okay, thanks, Darren. Maybe I take this question on the where is it? Sorry, the US banks. Oh, where is it? Okay, never mind. It's just asking about the outlook for the US banks going into this year, I think. Yeah. So looking at all the big figures. So revenues, net interest income will likely be moderately down, and this is mainly due to the funding costs, which will creep up incrementally for the first half, and asset use, which will be down because if the Fed do cut their rates. But nonetheless, if we look at the fee income, it will most probably pick up in some areas. And so when the rates do fall, the mortgage and investment banking fees should actually pick up. And lastly, for the trading revenues, it should remain relatively robust. For expenses will actually most likely increase because due to the inflation as well as investments in technology, which will raise their expenses further. And profitability, likewise, will also weaken somewhat because expenses will probably grow faster than the revenue. So it will probably lower their profitability slightly. For provisions-wise, it won't change materially from 2023. So that will be quite flat. I think, yeah. So I think overall, the banks will probably have to do quite a bit to lower the expenses, make sure that it's not so high, to ensure that the sort of flat top line does not get affected by higher expenses, to be able to maintain their profitability going into 2024. Yeah, hope that's just a brief overview of the US banking sector. Do I have anything else? No. Okay, I'll hand it over to the rest. Thanks.
Yeah. Okay. Thanks. So there's a lot of questions on value traps, and this is actually a very clear risk for a lot of the Singapore small mid-cap stocks. I think firstly, of course, a lot of the flows all go to the US. And secondly, with all these passive flows, nobody looks at small caps. So it doesn't mean you have a huge discount to NAV for some miraculous reason the gap will cover. So I think value traps is a very clear risk for all the Singapore stocks, small mid-cap. So as a result of that, when we pick small mid-cap stocks, we need to look at what actually in the end we have to just look at the returns we can get from the company. So those that do share buyback, those who do high dividend are the most attractive. Of course, if they can grow, if their growth is really strong, then there's the other attraction. Apart from that, the value traps is pretty evident, I think. Yeah, so any discount to NAV can be actually quite meaningless. It can just remain a discount for forever. Let me just move on to a lot of questions on Thai BEV. So nothing much to add. I think I already kind of elaborated our views. It's a very macro view. But my biggest worry is just the de-rating. I think if people see Thai BEV as a very X growth, then I think the valuations, we used to peg our valuations at 18 times. Now we're moving it to 16 times. I worry that the market consumer stocks used to trade at 20 times PE. but now it continues to contract, compared to semicon, because that one keeps on expanding. So this whole derating is my biggest worry on the Thai BEV performance. But hopefully with fiscal improving and Vietnam recovering, then that should elevate the stock. After that, I just worry it's going to just be very slow growth, X growth kind of situation, very matured growth for them. I'll answer these two more questions. I think I hand off to the technicals. Which are the better buys, AAM, UMS Venture? I think we mentioned we still prefer AAM amongst these four names, AAM, UMS Venture, or Franken, because the share price also came off. We'll answer this last one because it relates to the budget. So these questions don't really replicate. Also, how does the ABSD budget incentive work apart from property counters like Gorko? What sort of counters will impact? So what happens is that any developer that buys land, even en bloc, which I'm a bit surprised, they actually have to pay 40% additional buyer's stamp duty. So you buy a piece of land, you actually have to pay 40%. 5% is confirmed, but the government will give you back the 35 if you sell out every single unit in 5 years. So imagine if you have after 5 years, you still have one unit left. You buy the land for 100 million, which is very cheap. I mean, there's no such land as 100 million, but you have to pay 35 million penalty on it. So of course, this is a very punitive and all because it is to prevent developers from hoarding land. So right now they are moving it from 100% sold out to 90%. I think it helps, but 90% is still a tall order. But that's how it works at the ABSD. Okay, I think let's move on to the technical part there, because we usually leave some space for some of the technical questions. Yeah, over to you,
Okay.
Azin.
Okay, thanks, Paul. Move on to the TA. So first question will be on Keppel. So I think Keppel currently is trading above this 730 level over here. So I think for currently, it could do a bit of a sideways between the 730 to 740 range over here, given that this trend line over here is still acting as a bit of a resistance currently. So yeah, I'm thinking Keppel should do a bit of a sideways in the short term. And then as for Genting, it broke out above this $1.03 level. The near-term resistance is likely to be at this $1.06 previous horizontal support which it broke down off. So I think currently just sideways for a while in this range between 103 to 106, 107 over. The next one is on 823, which is Link REIT. Okay, for Link REIT, currently it's still trending downwards over here. But currently it's still holding this 37, around the 37.30 support level here. So I think it could do a bit of a sideways over here, currently between this 37.30 to about 38.90 area. But it's more towards the downside bias, given that we're still seeing a downtrend in this stretch with low highs and lower lows. Okay, this one is on Broadcom. So for Broadcom, currently it's still trading in this uptrend channel over here, but I would think that there could be some weakening of the momentum. We look at the MEC and RSI indicators, they are showing some declining momentum. I think it could trade a little bit more range bound. It could dip down a bit towards like 1,200 over here, and it just starts to form a bit of a range. Yeah, in the near term. Then next one is on Google. So I think Google looks a bit bearish for now. So for now, there was a gap down and retest of the East 140 level after results. Then we have it did a bounce to create a lower high. And then currently we are trading outside of this rising wedge pattern over here. We have follow through bearish candle over here. So I'm expecting probably lower lows to come to at least test in a very short term, to test probably 133 to 135, this range over here for Google in the short term. And for Amazon, I think currently nothing much going on. It's still in a bit of a range over here after the results. So currently it's still holding at around 166, 167, this level over here. So it could just sideways for a while first. Okay, the next one is on Tesla. Okay, for Tesla, I think some positives is that there's been range trading after the results. Then it formed a double bottom over here at a 180 level. And recently there was a break above this 194 horizontal resistance. So I'm thinking could just trade a bit of a range for now between this 184 to about this 207, 208 level, where previously was a range support over here. That quite as a resistance. So we'll just continue a sideways in a higher range as compared to this 180 to 194 level over here. Okay, and the next one is on BYD. Okay, so for BYD, it's still downwards trending, but recently it rebounded from this 174 level back to retest its previous support, which is around 190. So over here, it's likely to still find resistance over here, given that just recently this was a range level over here. I'm thinking it should be able to form a higher low over here in the short term over here, given that we have seen a higher low at 179 as compared to 169 over here. So we probably just sideways between the 180 to about 190 currently. Okay, then for Silverlake, Silverlake showed some weakness currently as it broke down this uptrend support line and price traded down towards the 24 cents level. But I'm thinking at this level, previously it was a swing low over here. We had a swing low over here as well. So could just move a bit of sideways between these 24 cents to about 25.5 cents range currently for Silverlake. Okay, then let me see what the TA questions. Okay, next one is on Alibaba. Okay, for Alibaba, I think currently still very range bound. Price is supported at the $70 level, but when it reaches 77, there's some resistance. So I think price is still likely to do a bit of a sideways range currently. Okay, then for Meta, it's a bit Meta is also currently just ranging. End of last week, we tested a high at 45 over here, and it pulled back. So we could be seeing a little bit of a pullback back towards the lower end of this range, like 450 to 460s over here. And then could just continue a bit of a consolidation for now. And then for AMD, also just currently in a range consolidation, resistance at 180, just recently retested, likely to see a little bit more pullback again. Still holding above at the 165 level. So yeah, we're still probably gonna see a range consolidation taking place still for AMD in the very short term. The next one is on Marvell. So Marvell, yeah, recently holding at the $66 level again. There was a rebound back to test this, so I will expect a bit of a rebound again towards like 69 or 70. There it's likely to be some resistance over here. Yeah. Okay, then next one is Applied Materials. Applied Materials. Okay, after reported earnings, then there was a gap up over here. So for the short term, could just consolidate for a while, given most of the stocks that gapped up after the earnings just consolidated for a while, yeah. But if it does trace, then I think 188, 189 level will be some support for the stock to bounce if it does go to those levels. But it should be able to I think it should be able to hold between 190 to 200s to do a bit of a consolidation for the short term. Okay, for the three local banks. Okay, first one is DBS. Okay, DBS I think is still showing very strong momentum over here in this stretch. We tested the highs around 34 over here. So think currently it could do a bit of a sideways consolidation given the fast run up over here. Yeah, but I'm expecting price to hold above the 3360 level over here, which was a prior key swing high resistances. And then looking at OCBC also, I think I'm expecting it to continue moving higher, given that it's just broken out this very long consolidation over here for about 30 cents range. So currently it hit about 13.30 over here. Yeah, could just consolidate for a while before moving higher, given that overall it's still in a very, very nice uptrend. Yeah, looking at OCBC. Then for UOB, UOB also retested around 29.40 this level, some resistances. So it could just sideways for a while over here first. Yeah, even a strong run up. Okay, then next up, looking at UMS. UMS also UMS also tested 146 this trendline resistance. So I'm thinking for now currently it could be a small pullback, some sideways, but I'm expecting the 141 level to hold over here, which was a prior resistance, and there was a gap up over here. So it just could consolidate for a while before moving higher afterwards, since it's still quite overall the price action is still quite strong recently. Then next up is Delphi. Yeah, so Delphi recently has been trading in a bit of a range over here, between like 104 to about 113 over here. Recently we tested the swing low support over here again, which happens to be his downtrend channel supports as well. So for now, I'm expecting a bit of a bounce, but it's likely to be weak, I think, given that 108 to 109, there's some resistance over here. Yeah, and overall it's in the downtrend as well. So we're likely to see a lower high form for Delphi. Okay, then next Franken. Okay, Franken is also continue to form a higher high over here, but I'm expecting some near-term resistance around 150. I see probably we're gonna retest this trend line again. Also 150 was a previous horizontal level as well. So yeah, could just do a retest and move a bit lower to form a higher low as it did recently over here. Okay, and also next one is on Jardine. Yeah, for Jardine CNC, after it hit the horizontal support level, which was around 26.20 over here, started to do a bit of a sideways action over here. So this could be like a double bottom where we should need some confirmation still. So if it is holds, I think it's going to do a small bounce towards 27.20 to about 27.40 over here to retest this neckline resistance and just do a bit of sideways for a while. Okay, then next up is on Palantir. So okay, Palantir after the earnings it was very strong. Rally above this uptrend channel over here. Price action recently has started to sideways for a while. So we did a retest of this 25.50 level and just pull back for a while. So I'm expecting a little pullback towards the range support of 23.60s over here. We could continue sideways for a while first. Okay, next one is on the STI. Yeah, STI has been moving higher for a while after a break of this downtrend channel over here. Also, when you look at the Bollinger Band, there's also a contraction to expansion going on currently. So for now, it could still move higher for a while towards a retest of this 3,260 level over here, which was the December end of December highs over here. Yeah. Okay, next one is on Sembcorp. industries. Okay, so for Semco Industries, I think for now it's likely to move in a bit of a range over here. It's still in this uptrend. I likely to see price finding some resistance around the 580 level and perhaps pulling back towards around the mid 560 level over here. Okay, then for venture, I think venture is doing a bit of a consolidation currently, likely an ascending triangle over here. Some resistance when it gets around the $14 to about 14.20 level. We're still seeing higher lows form over here. So yeah, likely some consolidation first, I think. And if it holds out, then perhaps you could see another leg upwards for venture. Then next up is on Thai Bev. Yeah, for Thai Bev, I think currently it's likely to move in a bit of sideways over here. Recently, price retested the 48 cents lows over here and rebounded. So likely, I think we're going to move between these 48 cents to about 53 cents, this range resistance currently. So likely to be sideways for a while. Okay, then for Olam, there was a gap up to retest these resistances today, which is around the 98 cents to about $1.02 over here. So I think with this downtrend resistance line that's been acting on it, as well as this horizontal resistance, it should pull back a little from this current area and could just sideways a while with 98 cents able to hold. If it holds, then perhaps afterwards it could move higher towards a retest of 107 to 108 thereafter. Okay, then for CapitaLand investment, I think is still showing some signs of weakness. It's still trending downwards, we have lower highs and lower lows. So recently, they had a retest of these 280s swing low support and there was a rebound. But I'm expecting price to turn down lower again. There's resistance around the high 290s over here along this trend line resistance. So we could see price go a bit lower towards the 280s again in the short term. Okay, then some of the Hong Kong counters again, which is 3032 HSI tech index ETF. Currently, looking at the price action wise, it's quite sideways over here. So I think it's just doing a bit of range consolidation in the process. But I think should be able to form some higher lows along the way with this higher low form as compared to this double bottom over here. So could form a higher low, then there's some strength could break out of this downtrend resistance line thereafter. Okay, then for Tencent, yeah, also some consolidation currently. Still price is still at around 295 over here, but positive is that it's forming higher lows over here. So yeah, likely to be an ascending triangle consolidation currently. So for now, could just sideways a little about around the 280s to 290s range over. Then next one is on Ping An Insurance. Okay, Ping An Insurance, I think positive is that it still is trading outside this downtrend channel over here. And then it's a possible inverse head and shoulders forming. However, there's still some key resistance around the $35 level currently. So unless there's a breakout above that could bring to about $37 followed by close to 40. Currently it looks like it's still likely to do a bit of a consolidation first. Yeah, but I think it's more towards an upside bias looking at the technical patterns. Okay, do you think Sim Leisure is a buy based on PE? Okay, I think yeah, based on looking at the chart, it's a long term. It's it's still uptrending, running around the 58 cents mark. But there's not much volume in this counter. So I think based on TA, it's very hard to be accurate to look at how it's gonna go. But yeah, it could still trade. It could still continue its uptrend over here. But if based on TA, around the 62 cents level, it's likely to see some resistance over there. Could see a pullback at those levels. Yeah, but I think TA shouldn't be very accurate for this counter given the low volume. Okay, technicals for Coinbase. Okay, for Coinbase, I think there was a strong run up over here to retest this the December highs around the 187 level. So on Friday, there was some sell down at this resistance. So I'm expecting price to pull back a bit to retest first of all level will be around 174 over here. Yeah, to close out this gap. Then second level will be around 162 over here. So I'm expecting a bit of a pullback first, given the strong run up to retest a previous high. So this could be like a double top for the time being. Okay, then I'll answer the last two TA questions on SIA as well as SETS. For SIA, yeah, there was a strong run up to retest the August highs around the 730 level. So at this level, I think could see a bit of a consolidation first, given the strong price run up recently. Then as for SETS, it's likely to just be a bit range bound to a bit downside bias. Okay, reason being, price is still holding at this 270 level here, but we are seeing lower highs from, especially after breaking up this uptrend channel over here. So could just sideways for a while around this 270 to about 280 range. But if you can't hold 270, likely we're going to see price come to test around 265, this range again. Yeah, given this downtrending portion over here. Yeah, so I think that's all from me for the TA. I'll hand back my time to my colleagues if there are any more questions answered. Thanks.
Yeah, thanks a lot. I think we run ahead. Sorry for that, because we usually try to end in 2 hours. But because the prior week we didn't have any calls, so that's why. And sorry, we can't really answer everyone's question. Although there's one very although there's one interesting one is Starhub better than Singtel or Singtel? Yeah, and if we prefer Singtel or Singtel, but mainly because we think the growth drivers are stronger there and they have a divestment plan. Yeah. Okay, anyway, with that, I'd like to thank everyone for your time. Sorry we overrun, and hope everyone have a good week ahead and have a happy Lunar New Year. Yeah, thank you everybody.